We now turn to one of the fastest growing areas of private markets, the rise of private credit and direct lending, sustaining returns as the market matures. I'm delighted to welcome our panelists. Christian Grobenski, Managing Director, King Street Capital Management, Edmund Costello, Investor Family Office, Murad Khaled, Managing Director, Marathon Asset Management, Vlad Lounegov, CEO of Mbanq, and Walter Gontarek, CEO and Chair, Channel Capital Advisors.
Thank you very much. My name is Walt Gontarek. I'm the Chief Executive Officer of Channel Capital, which does ABF private credit in the US, UK, and GCC. So I think this is the panel to beat it today. And we are truly blessed with this panel because I'm sitting with professionals that quite literally will be and are making decisions over $1 billion, several billion a year in the private credit space. So looking at different asset classes, looking at different geographies. So quite fortunate for us. After the introductions, we're hoping to tackle three main areas, three questions. Given the geopolitical backdrop, uncertainty associated with US policy, the hostilities in the GCC region, et cetera, what asset classes, what geographies are you guys looking at today and fancy today? Number two, what role does the GCC and UK play, for example, in the private credit markets today, whether it be a source of capital or otherwise? And then lastly, I know AI has been discussed, very well discussed on the previous panel, but what does AI mean specifically to private credit and what impact that might be having? And I think some of us use AI and technology in our decisioning and others are investing in the space. So maybe I thought I could start out with an introduction. Christian, maybe I'll start at the far end and we'll work our way over. If you could introduce yourself.
Sure. Many thanks, Walter. So, I'm Christian Grobenski. I'm running capital markets and origination in Europe for King Street. We are a 30 billion AUM firm, opportunistic credit investor in that space for the past 30 years across a number of strategies and flexible capital, and ultimately, given the topic here today, across Europe, the US, Asia, and the Middle East as well.
Okay. Murad, would you go next, please?
Yeah, happy to do that. And thank you for having me. So I'm Managing Director at Marathon Asset Management, which is a also $30 billion AUM business operating and credit investor operating across three major areas: corporate credit, asset-backed, and real estate. You may have, or some of the people in the room may have read that the firm has actually recently announced a merger with CVC, which is a very large private equity firm based in Europe, but very much global in reach. So I'm very happy to speak about that when the questions roll.
Excellent. Ed?
Afternoon, everybody. I'm Edmund Costello. I started my career at Allied Irish Bank in Dublin before moving across to Bank of Ireland, where I joined the then nascent real estate investment team, which we grew to about 4.5 billion AUM across European real estate and infrastructure. Then in 2009, set up a platform called Trinova, where we invested across the capital stack in real estate asset-backed opportunities in the UK, Europe, and the US, building a fully integrated multidisciplinary team of circa 50 people with just under 2 billion of AUM. I recently exited the Trinova business in order to launch a new platform later this summer, focused on providing equity and debt to mission-critical real estate and social infrastructure that will thrive as AI reshapes the economy. So I was very interested in the last panel, especially.
Vlad, you're looking pretty good given you flew in from the West Coast yesterday.
Oh, a little bit earlier than that, but yes, that's true. I do represent the United States on that crest above me. Even though I actually...
Proudly,
yes. Even though I actually graduated from the London School of Economics about 26 years ago and spent a substantial portion of my life in my professional career here in the United Kingdom. However, here today I represent the United States I founded a company called Mbanq, which is an infrastructure provider for financial services industry. I've been in the financial services for about 25 years now. However, my vantage point here on the panel is that we actually use private credit to deploy in loan portfolios of our clients, and primarily in the United States in a product called earned wage access. And I'll talk a little bit more about that in the future. So I am not only am I on the distribution side from the funds that we raise, but I'm also on behalf of our clients, we raise private credit funds in order to fund it, and we've been doing this for quite some time.
Excellent. Thank you very much, Vlad. So really, up until probably 2025, in my opinion, as just a student of financial markets for 30 years, private credit was the white-hot area really since late 2017, 18, 19, until middle of last year. And then all of a sudden, these cockroaches appear, according to one of the top bankers of the world. Of course, well, he's talking about cockroaches, and he's right. On the other hand, he's announcing major private credit initiatives of his own, which is very wise and prudent of him. But I get confused. I get confused hearing about BDCs and leverage and people losing money and bad underwriting or bad structure and whatever. So it can be easily a confusing space, private credit. It's a broad term. So with this in mind, maybe I could just start out and ask each of you, what areas within private credit, more generically and generally, are you allocating today and you like, whether it be product geography-wise? Maybe, Christian, I'll start with you if I can.
So we see, probably the best risk-adjusted returns at the moment, not in the, I would say, mainstream direct lending private credit area. So we're allocating most of our capital in more complex, let's say, sophisticated, less crowded markets, and ultimately with rate moves over the last 5-6 years, there's a growing opportunity set on that end as well.
That's an interesting theme. So essentially, you didn't use the word, but it's almost more and more solutions-oriented financing in some regard.
Yes, for sure. I mean, ultimately, you're entering a phase now where sponsors' M&A exits are not given any longer, right? So they have to look for different solutions or how to prolong or find different routes out, and there's obviously multiple ways to achieve that nowadays, but it's definitely at a higher cost of capital than it happened 5-6 years ago when you had massive inflows in this market, right?
So, and just last question on this point, please, if you don't mind. When you are in a deal and you're in competition or you lose a deal, are you losing it to a bank, generally speaking, in your space?
No, I think banks are less well, I don't say less active, but certainly more prudent and given regulatory standards in these markets. So, I mean, I lose it to guys like Murad, right? At the end of the day, and of course, everyone has like slightly different standards in that sense. But equally, we're probably not losing it to the guys that have essentially started these businesses 5-6 years ago because that they're suffering with their own problems in terms of weakening underwriting standards and ultimately volumes, right, of deals that are coming their way that are not as easy to get off the books or refinanced again.
Excellent. Murad, what's the view from Marathon, please?
Look, I agree with a lot of what Christian mentioned. I mean, I think in terms of the opportunity set going forward in the context of your framing around Jamie Dimon's comments, I would say that across the entire spectrum of direct lending, which is more plain vanilla, senior secured type financing, which does compete with banks, there has been a lot of noise in that space, and I know we're going to come back to that. And then credit solutions, which is, I think, being given a new lease of life because of the lax underwriting standards in direct lending. So a lot of businesses that have now suddenly found themselves not over-levered from a sort of debt to equity perspective or leverage perspective, but from a interest coverage perspective, are finding that they are, in need of more creative solutions, junior, otherwise type of capital. So those two areas for us are still very active, but I think the opportunity set it has to be born of very forensic allocation decisions and deep due diligence. I mean, that sounds pretty generic, but I think it's going to be proven out. But I think if you get that right, certainly our CEO, Bruce Richards, will publicly state as many times over that we're entering a sort of golden era for direct lending, certainly in absolute return terms, as long as you can manage out some of these legacy COVID or ZERP type underwrites. I'd say the other area that's really a really big focus for us is asset-based, and our asset-based strategies are quite distinct in that we don't necessarily major in consumer unsecured, so things like credit cards, receivables, auto
Which is
loans,
all asset-backed in principle.
which is all asset-backed in principle, but we define it as those are IOUs, pieces of paper that people sort of have to sort of abide by. But we rather have a bit more of a skew towards hard assets, so aircraft, shipping, rolling stock, power, utilities. And the reason for that is there is really a recoverable value. There's a residual value. And a lot of the time, the value of those underlying assets are quite uncorrelated from the businesses that own them. So they can equally be a source of liquidity and solutions-orientated capital for what otherwise might be a stretched corporate capital structure. And then that's from an issuer perspective or a user perspective. But from an investor perspective, we also feel pretty well insulated, given that we have to take views, and ultimately, if we get it right, we have an accurate view around the underlying residual value at the end of the loan of that asset. We have a good idea of how that asset can be repurposed for its next sort of leg of its life, and the costs associated with that. And it's not an easy market to enter overnight, because these are, sort of multiple cycle deep domain expertise. So that's an area that we think is, also very interesting right now and coming into its own.
I've seen myself research by Fitch and AFA that had recovery rates for the direct lending product, which used to be called BSLs in the old day in banking. Maybe Christian vaguely remembers that. And the difference in recovery rates is for ABL, real ABL, like you say, hard ABL assets could be like 90% recovery rate, and then for the more unsecured, 5-7 year product, could be as low as 30-40%. So it really is a different outcome, isn't it? And has a big impact on returns over time. Well, that's interesting. Ed, maybe over to you a little bit. You're operating in a narrower but very, very interesting space. Maybe you could talk a bit about real estate.
Sure. I've spent all my career in hard asset-backed activities, real estate and infrastructure solely. And I guess the last few years we've seen, post the pricing correction, some opportunities in the NPL side of things, which were more single asset NPLs rather than portfolios that we saw post GFC. But most of our activity has actually been in providing solutions, not too different to what the guys are doing, but providing pref and mezz to plug refinancing gaps. Loans that were done in 2018, 19, 20 that have probably been kicked down the road a couple of times. The extend and pretend is now coming to an end, and that's creating liquidity opportunities. And certainly, looking ahead, one of the main focuses of the new platform will be to participate in providing pref and mezz solutions to plug refinancing gaps at what are historically attractive entry points from a valuation perspective. And the UK very much central to that for us, with significant repricing having taken place, with significant barriers to entry for new supply. Nobody can afford to build anything, so which is going to lead to income growth, rental growth. So you're going to generate some attractive returns from income and income growth, which I think is very attractive.
Thank you very much. Maybe we could move on to geography for a minute and think a little bit about, given the backdrop, geopolitical and otherwise, what geographies we all are looking at that way. And maybe just starting for myself, our firm does ABF lending in the UK, US, and GCC. There are hostilities going on in the GCC. We had the gentleman from Brookfield earlier explaining this morning that it's business on, and certainly in the UAE and Saudi, and I really echo his comments from this morning at Brookfield. And we're finding it a wonderful environment down there to work with high-growth companies because we find, and Christian, I know your guys are very active in the region, and you have people on the ground there in Saudi, for example, but it's an underbanked market, whereas in the US, the banks were active at a point in time in the past, and they ceded the SME and the working capital markets to non-bank lenders. I don't think the banks have ever been there in the GCC to begin with. So you can go in and extract extra value and give entrepreneurs growth capital. So we quite like the GCC market. But for those of you that, let's start out with maybe raising capital, here at this panel. I think Ed has. I'm not sure about Marathon. Christian, your firm's announced a very significant investment in capital raise with a very prestigious partner. Maybe you could touch on that in the GCC.
Yeah, sure. I mean, we just announced a partnership with PIF as an anchor investor for a new credit fund targeted on the GCC. So local investments. We'll have first close of this at some point in Q3, but already up to this date have probably a working pipeline of reasonable situations up to like $1 billion, which is ultimately the fund value. It'll be focused on predominantly, corporate asset-backed real estate infrastructure investments. We're also quite active in the claim space, so we can cater all areas of the market, and ideally are targeting a space there that is probably an intersection between one and on the market, which is obviously heavily bank financed, and I want to say quite prudent capital. On the other hand, you have local private capital, but that's probably targeted more towards SMEs and smaller situations, and we're trying to address the middle space of larger opportunities that are requiring private capital, and ultimately, I mean, to no surprise, we've seen an inflow of institutional capital into the region over the last, I'd say, a handful of years anyway, right? I mean, right after the financial crisis, I think that space was intermittently frequented by counterparts like us, investing in all sorts of situations, such as claims or larger conglomerates. So we've been doing that in the region for the last 20 years, on and off, and intermittently. But you've really seen sort of like post-COVID an inflow of institutional capital, which probably hasn't existed for the 10 years after the global financial crisis. Yeah. We've been working on that vehicle for the past 3 years, obviously trying to strike relationships or having struck relationships with local stakeholders on all ends of the market. And so the current crisis ultimately came in the midst of our announcement, which is probably both a complication to a degree as well as an opportunity. Yeah.
That's amazing, because I mean, I often find people that are either novices or maybe they're learning about private credit. You would think that announcing a $1 billion private credit mandate from PIF to deploy money in the GCC during a crisis, during hostilities, sounds counterintuitive. It doesn't sound very smart. And actually, you and I might argue you run to the fire if and only if you're focusing on what you know very well and others are putting all their tools down. Is that right, or do I have that wrong?
I mean, you are seeing this trend in every other crisis in every other region, that there's almost a flight, I don't want to say flight, but certainly a trend investing back in your home markets and going back to your core markets. So ultimately, allocators in the region, right, are very active internationally and have done that for the whole time, and they continue, like sovereign wealth funds, etc., continue to be a predominant figure in that space. But we're also seeing that they start to realize there are equal opportunities in their home markets, which could be quite interesting. And I think the fact that they're choosing a manager like us is probably a mixture between, you have a 30-year-old track record, tight underwriting standards to what Murad has been describing, because ultimately we're spending a lot of time on these situations. And we're trying to marry that with a jurisdictional framework that's probably not that proven yet, but with the same sort of standards that we approach every other investment. Yeah.
Jurisdictional framework, I love that word, because I think about that, like even the Emirates versus Saudi, which touch each other with respect to the border, Middle East GCC, the way you would enforce your claim as a lender will be very different in the DIFC or ADGM in the Emirates than you would in a court action in the Saudi courts. They both work, but they're different. So I think you have to have that. That's well said.
Yeah. Right.
Murad, how about yourself? I know you from a market-wise, you're looking at Europe closely, aren't you?
Yeah, well, I think, I don't view any of these regions as competing with one another. They're complementary, and I think we're very much an investment-first sort of firm. So if there's quality opportunities on the ground, for example, we've invested in GEMS. We're an equity holder in that business, which is one of the largest education providers in the UAE. Well, to be honest, I would say that there are some relative advantages of Europe and disadvantages versus the GCC. I mean, clearly on the fundraising side, we are in line, obviously together with CVC, that will only be enhanced, but we're very much in line with all of the sovereign wealth funds, government arms that are looking to get into alts. I think we've got our fair share of that from a capital raising standpoint. So I think that's pretty well understood and probably known. In terms of deployment, if I just take a step back, the advantage that Europe has right now is that there is this big capex wave that's needed. I mean, you just have to look around the streets of some of the capitals of Europe that there is infrastructure upgrades required. There is a huge amount of, I would say, delay and dysfunction in terms of political consensus around addressing capacity, real estate, infrastructure, power. There's obviously a rebuild of defense that's needed, and a sort of native compute that needs to catch up with the US. So all of those provide opportunities that are quite distinct to Europe. On the flip side, Europe's very overbanked, still very much so. It results in some unnatural capital being deployed, which is a disadvantage. And then, I think overall, yes, there's greater certainty around most of the, I would say, Western European jurisdictions in terms of the framework for a lender. But there is versus the GCC. But I think in the GCC it's easier to arrive at changes and political sort of, I would say, motivation to get things upgraded, renewed, modified, so that they are more investor friendly. That just happens faster there. In Europe, it's a question of, I mean, even in Germany right now, there's this huge bill that we're all anticipating will pump trillions into the economy. And if you speak to anybody at KfW or the Ministry of Finance, Landesbanks, none of them can tell you how it's actually going to reach the real economy. And that is, I think, somewhat emblematic of the political, sort of disadvantage in Europe versus the GCC. So we're taking a broad approach.
Thank you. Vlad, maybe for yourself, before we talk about Mbanq, we'll get to that, I promise, but from a U.S. perspective, and you've been in advisory and in fintech oversight and helping companies launch for many years, but from a U.S. geography, you look at the U.S., I'm an American citizen, I've lived in Europe for 30 years, you look at, I think, very high long-term bond yields, 100% GDP, the government debt is equivalent to 100% of GDP. You have to go back to 1946. After World War II, when you were at these levels. So this is where we are now. Stock markets, on the other hand, are at an all-time high, and we've declared a war action, which, if I listen to Tucker Carlson, I believe we want to get out of that war somehow with our pride intact. So I'm just trying to understand, what is your view of the credit environment in the United States as an interested person?
That's a great question. I think one thing that all commentators, including Tucker Carlson, forget is that what's actually happening on the ground in the United States. About 78% of all consumers in the United States, they live from paycheck to paycheck. So if there is an increase in gas prices, petrol prices in the US by $10, $20 per week, it actually hits the hardworking American population. And I think that a lot of commentators are talking about the effect or impact of war on the economy overall, but they forget that the people who drive the economy, the driving force behind the economy, is just those people who drive trucks. You know, they deliver your Amazon packages. They're the ones that send, you know, bring stuff home to you and pack shelves at supermarkets and work in hospitals as doctors and nurses. And this is where we think that there's a huge opportunity. If you provide if you provide products to them that are suitable for that demographic, which actually is very resistant to adversities like the war, like the increase in cost of energy, you're actually able to deliver something that is more stable than any other types of credit. So we use private credit instruments in order to fundraise, to provide liquidity to hardworking Americans with a product which we call earned wage access. In the United States, you have 24 pay cycles per year, and that's why duration between a paycheck to a paycheck is only 14 days. So if you think about that as the term of your loan, it's not even a loan, right, because it's under 30 days, but if you think about that, the risk of people not returning is substantially low, and not just because of the duration, but also because of the check size. So our check size for the last 6 years have been around $206. So if 1,000 hardworking Americans default on $200,000, it makes absolutely no difference to the portfolio. And so coming back to your original questions, you're absolutely right. The economy right now is in a bit of a weird spot. However, the United States is still the most lucrative and the strongest economy in the world, and financial services in the United States still remain very strong. And the fact that the whole economy is driven by those hardworking Americans is very much overlooked. Banks don't want to bank them because they think that they're either subprime or near prime, right? If an advance, which we call it, is less than a month, they cannot put it on their balance sheet as an asset, right? So then what happens is that millions of those hardworking Americans don't have access to credit on the one hand, but on the other hand, this opportunity is not open to everyone. So that's why I think that people like us are able to actually take advantage of the situation and use it for our advantage.
Well, I hear that. I agree with you 100%. I had my cousin over from King of Prussia, Pennsylvania this week, and he's a senior executive GSK. And we were filling up my car with petrol, and he's very smart. He did the calculation of liters into American gallons,
yeah.
And then he converted pounds to dollars. And I think we're paying a little bit more in London than you guys are for petrol, for gas.
Well, so the difference is not just how much...
There's taxes, yeah.
There's taxes as well, but also historically, gas prices in the United States were quite low. And this is what makes a lot of people unsettled. The United States is self-sufficient in petrol. However, because of the way that those petrol companies are structured, if there is higher price elsewhere, then the resources will be diverted elsewhere. Yeah. That's why the prices at the gas pump, at the petrol pump, are actually substantially higher. And the difference is not how much you pay at any point in time, but the difference is that how much increase have you endured in the last few weeks or few months. And to be honest, the increase in the United States has been very significant.
Edmund, can you talk to us a little bit in your sector, your area of focus, real estate, geography-wise, what do you think is an area you're very, very excited about here?
Well, looking across Europe, there's a number of areas that are interesting, but the UK stands out head and shoulders above everywhere else right now. I touched on it earlier, the repricing that's taken place. There's been a very uneven repricing across real estate sectors, but they largely reflect fundamentals. You've got significant barriers to new entry for new suppliers, so very little being developed, and that's not going to change anytime soon. So you've got strong growth fundamentals, and you've got a competitive financing market. So you put those three things together, and prospects look pretty good. So for us, the UK, both on capturing the opportunity out of the end of extend and pretend, providing those refinancing gap solutions, alongside traditional equity ownership. That's our focus right now.
Thank you very much. Okay, so next moving on to other areas of private credit. When you look at private credit in headlines, I hear things of two camps. One is the underwriting was poor in 2021. I think you guys have touched on this repeatedly, and that may be partially right. Banks used to, by the way, it's not just private credit. Banks sometimes have underwriting. You know, Christian, as you know, you and I worked for large banks before. They have underwriting challenges too, not just private credit. But were some of the issues in the past, you think, underwriting and lack of due diligence with some of the cockroaches? Or do you feel more of the issues that we're facing or will face are regarding a structure of a fund, putting leverage in a BDC, selling it to the dentist in Connecticut or Toronto? Or is it easy to sort of separate and tease those out? Any thoughts?
Yeah, look, I think there is certainly a little bit of that in terms of what has been sold hasn't necessarily been unpacked fully for retail investors. The structures, I think, are less, in my opinion, less of an issue than the marking of these positions. And what I mean by that is how the individual investments are valued. I think a lot of them, given the private nature, don't have the same degree of immediate, real-time and tangible scrutiny that the public markets do. And as a result, I think that has been, that sort of, if you will, the original sin that has exposed some of the shortcomings of the structure, or perhaps immediately, in a very quite stark way, I think, come up to the surface for retail investors who perhaps hadn't read the fine print. So I think that issue, if it's addressed and resolved, which I think the market will have to do, it will have to reflect and have to find mechanisms to do that. I think that will carry a lot of the resolution load, if you will. But certainly, you know, I think structures, there'll be some sort of bright lights shone on the nature of those and the appropriateness of those. But I think the heavy lifting has to be done by a little bit more transparent, real-time, reality-based marking of these positions, and that will be the foundation for an improved, upgraded version ready for the retail markets.
One of the things I'd be interested in what Christian thinks, but one of the things I was talking to Christian before this panel is that I read that I won't mention the name, but one of the fund managers that did BDCs with leverage, of course, they first put money in, and then they tried to keep things going. Then they put some gates down and limited withdrawals, and this is very typical. And then there's article after article after article in the Wall Street Journal about how terrible the IT sector is going to blow up 35, 40% of your portfolio. So these people are holding these illiquid funds, and these are dentists in Toronto or Connecticut. And you know, someone comes along with a hedge fund saying, we'll buy your units for 60 cents on the dollar. If you need liquidity, we're here for you. And that's fair enough. That's the way the world works. And then, you know, pity the person that sold, frankly, from what I know today, their fund at 60. Pity, because we don't know those are realized losses. And I read recently there's about a 1% of those holders have actually sold their fund. So for all the noise, people have held on. But Christian, I don't know if you have a view about this issue.
I mean, I think there's no, I don't want to throw any of my current or former colleagues under the bus who underwrote direct lending deals 5-6 years ago, right? But ultimately, a lot of these structures were done with the assumption of almost perpetual EBITDA growth. Yeah? And clearly now you are approaching the market at the current time, and ultimately most of these companies have not been growing. Your interest rate cost has obviously been, the base rate has tripled, quadrupled, right? Your cost is just going to go higher. I don't even want to criticize, I'd say, the performance of some of these credits or like the underlying products, but clearly what you described on what's been happening on the BDCs, it's almost like a bank run, right? In terms of, it almost doesn't matter what the underlying product is, and obviously we've seen this to perfection with banks back in the GFC. This is nowhere near it, but it has some similarities in terms of when investors pull out their capital, it doesn't really matter what you tell them and what the underlying product is like. And we see this now following through in areas of continuation vehicles from direct lenders that have literally no opportunity to either sell these businesses or refinance them. So ultimately, you just keep rolling and kick the can down the road, which is almost like bank-like behavior, what we've seen post GFC for the next 10 to 15 years. LP secondary transactions, right? There's another area which has been growing almost exponentially over the last 5 years in terms of how can LPs get access to their liquidity. So that's a growing market that we're also focusing on. And needless to say, right now, private credit LPs have some concerns, right? But I guess we'll just have to see. I think all it does at the moment is it increases our opportunity set. What you've said in terms of AI software is ultimately an area of the market I almost want to describe. You always have this happening once in a cycle. I don't want to say it's something abnormal, but clearly we'll now have to consider this in pretty much every underlying underwriting process on how we approach it. But these things can happen. But
Thank you very much. Vlad, maybe we could talk a little bit about fintech and private credit. I don't think there's been a lot of fintech discussed. I know you were in the earlier panel this morning, but that's something, you know that space in Europe from your days when you were at, I think it was PwC as co-founder of the fintech practice. Arguably you're running a fintech now, you know the space well. To what extent do fintech markets and fintech lenders around the world rely on private credit in order to fuel their business?
Yeah, that's a very good question. Actually, most of successful fintechs would need to find some kind of capital to be able to give out as credit. If they just focus on deposit programs, we found that most of fintechs inevitably cannot survive because just deposit programs don't really yield a lot of returns, especially to hungry VCs that have invested in them. So every successful fintech sooner or later will go into some kind of lending. In order to fund lending, you cannot go back to a bank and say, hey, look, I need a $100 million facility to lend out as earned wage access, right? So you need to find ways where you would fundraise. And one of the most successful ways, not just for Mbanq, but for many other fintechs that I'm familiar with, has been private credit. And the reason for that is because even if you look at, and I will go to institutional level as well, but if you look at the level of private banks, for example, when a high net worth individual that is easily writing a $50 million check comes to their advisor and says, look, I've already invested in real estate. I've already invested in different geographies. I've already invested in Bitcoin, AI. I've already invested in every buzzword that there is, right? So what else can I do? And like I mentioned earlier, it's amazing how much interest there is in credit-linked notes or private credit type instruments that you can sell through the wealth management channel. So, and it's not just Mbanq, but many other fintechs that I know of, they've been very successful in fundraising that way. Now, what's happening now is that a lot of them have grown up and have become pretty big, and the portfolio sizes have been really big. And inevitably, they start displaying behaviors like they're a bank, to be honest. Even if you look at Mbanq, for example, so we do deposit programs, and we've done about $1.4 billion in paycheck processing over the last 12 months, in addition to about 400 million in third-party payment processing for corporates. So our transaction volume has been almost $2 billion, and we've issued about 800,000 of those paycheck advances with an average check size of $208. So if somebody looks at us, they would say, hey, look, you're like a bank, right? So you have a deposit program on the one side, and you have lending on the other side. However, how do we fund? We cannot use, because we're not a bank, we cannot use the deposits to fund our ability to lend out. So we still go to private credit and other markets, high net worth and wealth management channels to be able to fundraise. And this has been going on for quite some time. And to be honest, I think that this is one of those drivers now that some of the fintechs are becoming fairly big and fairly substantial, that they become more of an institutional size, where the institutions come out and say, hey, look, I'm going to take the entire $100 million raise, or I'm going to take entire $250 million raise. And like in our case we discussed earlier, we're also going after Sharia-compliant notes as well, because the interest in those instruments is so substantial that we've issued our first United States dollar-denominated credit-linked notes. Now we're planning euro, Swiss franc, and pound sterling notes, and in parallel to that, we're almost cloning it to be compliant with Sharia law. Also simply because the underlying product, earned wage access, is Sharia compliant, because there's no interest paid, right? So people pay membership to be a member in order to be able to receive the advance. So all of those channels that take place, but now the size of those fintechs, like what you said before, it's more of a dramatic size. You know, it's no longer a tiny company, and fintech itself is no longer just a way to describe a startup. You know, some of those fintechs are already quite mature and then have reached the institutional grade.
One of the focuses at Channel is Sharia-compliant lending. We won a reward last year for FlapCap in the UAE, the Sharia-compliant financing, but it was ABS Deal of the Year. Not Sharia compliant ABS, just ABS Deal of the Year was Sharia compliant. And I guess it sounds like your experience is like ours, where you visit, we've had Sharia foundations from Riyadh say, please help us develop solid, good investment products that we cannot find otherwise. We're already in real estate, we're already in commodities, we're already in equity, but we need to find from a diversification perspective. So I guess some of your products are probably not interest bearing. Maybe you could explore just a little bit more. I think you recently have done some issuance in the private credit space, and how did that work, and why did that work well?
Right. So I'll also touch on the Sharia first. So the notes that we issue currently in the United States dollars is 12.5% coupon. In Sharia compliance space, you don't have anything similar to that, right? And so if you look at the underlying business model, okay, it might not be airplane engines, or it might not be the real estate asset base that you would think as a collateral. However, the duration of our advances is pretty short, right? And so, like I said,
what is it, like 2 months?
No, it's only 2 weeks.
2 weeks.
Yeah, and the reason for that is because we basically collect from the paycheck from the employer in the next pay cycle, and there are 24 pay cycles, and so the funds rotate 24 times a year. So that's why we're able to offer returns that seem to be fairly generous. And in Sharia space, maximum DC is typically 6.25%.
On a sukuk, yeah.
Yeah, on a sukuk, yeah, exactly. So when we came out to them and said, look, of course there is a bit of Sharia compliance and so on and so forth, but we can still offer superior returns in comparison to the papers that they currently have available, we get a lot of interest. So much interest that, to be honest, we're thinking of establishing part of our organization just focus on that side of the business. Now, granted, we've never deployed capital in GCC countries, so right now our focus has been United States. One reason for that, not just because we know it very well, but because of how payroll is structured in the United States. You have 24 payroll cycles versus 12 in the UK. However, our next market is the UK. So this is where we are.
Is there an announcement coming in the next little while, maybe, in the UK?
Yeah, that's correct. There are announcements coming out. I cannot tell all of the announcements, but some of you might know that we're a major sponsor of a football team here in the UK, Bradford City. They almost made it to Championship League, but we love them. They're absolutely amazing, and so we have a very deep relationship with them. And in addition to everything, they have a very substantial consumer base as their fans. And so we think that with that footprint and the stronghold that they have in West Yorkshire, which is just a demographic that we need, hardworking Brits, right? Because we're so successful with hardworking Americans, we think that we'll be able to make a substantial change in people's lives here as well.
That's great. So just as we round up with one or two last questions, notwithstanding some of the macroeconomic headwinds that we discussed, the long-term rates are very high, sovereign debt levels are high, hostilities, supply chain, Straits of Hormuz, I can't believe, are still effectively closed, making it very hard for folks in the GCC to do business. If you look at where we are today, rapid fire question, yes or no, and explain. will private credit be more important in the next 24 months as a source for solutions? Or do you feel we're sort of going to plateau for a bit, given this uncertainty? Anyone?
Yes, for sure. Particularly with the current state of, as you mentioned, all the bad news, the BDCs, Iran war, inflation, and so on and so forth. Clearly, there's a part of that market which will gain more importance. Over-levered cap structures, we all need to address them at some point. Some will be able to do that better than others, but clearly there will be parts of that market which will get you paid for complexity, sophistication, and the fact that regulatory constraints on the bank side will not allow them to play in that space, and that's why investors like us will be able to monetize from that.
I think you and I were talking before. I know you don't believe interest rates are likely to drop a lot anytime soon. I don't think anyone in the panel would believe that. So that keeps pressure on the interest coverage ratios of borrowers. And that's why maybe some of these more secured or short-term products that we're talking about here becomes very attractive in that environment, because companies are facing higher interest bills, but it does present a very attractive asset opportunity for allocators across this table here. Murad, do you want to add anything in terms of this question mark?
I think your answer, the question to your answer, the answer to your question is absolutely. It's just a scale, function of scale. I think the European industrial renaissance, as perhaps other people have referred to it, is going to need the mobilization of private capital. Asset-backed is probably 10 to 15 years, or direct lending and traditional private credit, where that was 10 or 15 years ago, asset-backed is at that point now. We see that growing at roughly 20% CAGR in the next 5 years, and currently direct lending makes up around 65% of private credit. But I think asset-backed, solutions-oriented, and this is excluding private IG, will catch up. And then finally, coming up to sort of that topic around private investment grade, again, I think it will become an accepted, scalable, alternative source for treasurers in large cap corporates, for governments. And I see a lot of that having tremendous application in places like the GCC, for example.
Very much. Ed?
Yeah, I completely agree. It's a strong yes for me. Looking at specifically the area that I'm focused on, real estate and infrastructure, where you've had a significant repricing. Values are a lot lower than they were 5 years ago. You have a wall of refinancings coming through, many of which should have started coming through 2-3 years ago, but the banks have been extending and extending. But
which requires the solutions-oriented approach you all are discussing.
Correct. And what you have, and I think, Murad, you touched on this, is serviceability is a big challenge. And you've got conventional banks, they're still in the real estate and infrastructure game, but they're maxed out at 55-60% LTV. But they can be competitive at that level. But that doesn't work. So you need someone else to come in and help pull the capital stack together. And private credit is an essential component of that. So a strong yes.
What? Go on.
Sorry, and a strong yes from me, as you understand. And one thing I would say as well is that during times of uncertainty, especially when you have not just one but multiple wars going on, nobody knows what's going to happen tomorrow. Then all of a sudden you have this AI going on and so on. I think it's a great opportunity, and I think that the solution this time around for the current situation will be private credit. And so I think that its importance will dominate, I think, the solution set in the next few months, if not years.
I would add just one thing about it's just the downside protection as well. You touched on Jamie Dimon's words, but I think they were relating to the kind of wider private credit landscape. When I look at my area of focus, there's real downside protection in private credit into real estate and social infrastructure, where assets again have rebased. Your entry point is fantastic.
I'm hearing a lot of enthusiasm about growth, but growth with prudence. So that's wonderful.
Yeah, and also understanding the underlying businesses. Sometimes the historic association of private credit with just giving out loans right, left, and center without really understanding as to what the underlying business case was or use case, I think that doesn't exist anymore. I think people are a lot more advanced, the investors are a lot more advanced, and it doesn't help that the media is not in favor, so that's why everybody is looking almost at every opportunity under a microscope. So I think everybody's become a lot more educated on private credit right now, and I think that's where we're likely to experience substantial growth.
I mean, that's really great. Thank you very much, guys. I mean, when you read again these headlines and you think that everyone's losing money in private credit, and I think the reality is quite different. And there are some specific areas that need focus and improvement. It creates opportunity, but it sounds like a very exciting space. To the panelists, I want to thank you very, very much. You guys are amazing. Thank you very much.
Thank you.